Hello, everyone, and welcome to our third quarter of 2018 market and retirement planning update. Yes, we're in the second half of 2018 already. Most of you have already celebrated the 4th of July. Maybe a few vacations are still going on. We're back at it here in the office. So my goal today is to provide a little bit of a review of what's happened over the past quarter, talk a little bit what's happening within the economy, talk a little bit about sort of the big news right now, especially politically, is are we heading towards a trade war, and what does that mean? And then just look at some things to watch here as we move forward into the second half of the year. We look at market performance. Candidly, it's been a very uneventful first half of the year. Obviously, we had a little bit of volatility in February into March. Obviously, the markets continued the run that they were on in 2017. But then as we sort of rebounded, really, if you look at most of the major indexes here in the US, they have been floating plus or minus a couple of percentage points. If you notice that, we'll see that the NASDAQ has performed fairly well early part of the year. That's predominantly driven by a few large tech companies that are really holding up the market. Think about Netflix, think about Amazon, Google, Facebook, Apple. These companies continue to be major leaders within our whole economy, but also their strength, their services, all the different products that they are delivering continuing to expand. So I think these are the new leaders that we'll see here in the years to come. As I show, most of the US markets are very, very stagnant. If we look here closely, you can see that developed Europe, the MSCI is down about 2.3%, and emerging markets are down about 6.5% for really the worst performing asset class that we have within our portfolios. Candidly, emerging markets was by far our best performing asset class last year, so to see that retrace and maybe stabilize a little bit really wasn't all that unexpected. I think some of this concern over trade wars and some of those things maybe do have a little bit of impact on that, but that will be seen. As we looked into the fixed income side of things, or within your bond portfolios, we really have not seen much of any movement there. And in fact, really the first time we've seen in a few years, we've actually seen some negative returns in these asset classes. This is predominantly driven by the fact that we are now in a much more rising interest rate environment. We did see that here, another rate increase here in the second quarter, and we expect to see one, if not two more, as we close into this part of the year. Now, the important thing to remember when looking at rising interest rates is that tends to typically be pretty good for the economy, because that means our Federal Reserve are raising rates because they want to control the growth. And if we have growth, that means that provides them the opportunity to raise rates. Now, the problem becomes is if we raise rates too quickly and too fast, that we then maybe send the economy in the wrong direction. So that's something that the Federal Reserve really has to hone in on, and really is kind of the thesis of their discussions and decision-making processes along the way. Now, not to get too technical, many of you read this in our weekly commentary, but a lot of people look at what are called the interest rate spreads, and that's really the difference between the 2-year Treasury and the 10-year Treasury, these two numbers here. Now, historically, when the 2-year Treasury has exceeded the 10-year Treasury, that's often referred to as what's called an inverted yield curve. And so when we look at the spread between these interest rates and the yield curve, this in many cases has been a fairly accurate predictor in predicting a recession. Now, the problem with that is it doesn't say that the recession just happens 3 months later or 2 months later or a year later. It just shows that it's a good leading indicator. So let me give you a quick example. If we look back a year ago, you can see that the 2-year Treasury yield was 1.38 and the 10-year was 2.27. So essentially about a 0.9% difference. If we fast forward to this year, we see that the 2-year is at 2.25% and the 10-year is at 2.85. Both have went up, but that gap has now shrunk to 0.3%. So if we see that 2-year Treasury bill exceed the 10-year, that may signal the market to be a touch more cautious. And believe me, you will hear about this in the news and in the media, because this is no secret as a predicting indicator of recessions. So just a little piece to look at there. So when we look at valuations and metrics, this is something that I've always shared in being very consistent in our quarterly videos. And so what you see here is when you look at valuations of today and the 25-year average, we're really not that much overvalued again. If you look at the chart, here we are, we're almost right at our, from a price to earnings ratio, our 25-year average. If you look at some of the other metrics like dividend yield, price to book, price to cash flow, boy, they're almost the exact same. So overall, I am not worried about the market being overvalued. It seems to be pretty fairly valued. Now, if you strip out some of those large growth companies that I just spoke about, Amazon, Netflix, Google, Facebook, and I'm sure I'm missing a couple, the market actually tends to be a little bit undervalued. So again, these don't sway the market one way or the other, but we want to make sure that we're looking at these things closely and we're giving you good quality feedback. Again, real briefly, looking at S&P 500 profits and earnings, they continue to be at record highs. So my point here is that because the market is at all-time highs, the reason is that companies are making lots of money. And I know I am fielding the question a lot in reviews and in calls that, geez, you know, market's at all-time highs or near those highs, it's got to correct. No, it doesn't, because here we are seeing that companies have never made more money than they are today. So therefore, that would lead to these high valuations that we are seeing. Now, when we look at the residential real estate market, I know here near our primary office in Woodbury, as well as across the country, is that the housing market is very, very strong. There are developments going up everywhere. Homes are flying off the market. I know from some of the realtors I know here in town, specifically, the average selling time is less than 30 days. It's a very, very robust and strong market. And here are some stats to back that up. Mortgage rates tend to be very low in the upper left, right? That has not changed. Yes, they're starting to creep up a little bit, but they're still extremely low when we look at historical averages. We look at home price relative to income. We're seeing that, you know, it's starting to creep back up, but it's not at all-time highs, which is good to see. Housing affordability index. The reason that home prices are high is because people can go out and borrow money with these low interest rates, and so that's driving up demand for homes. It's much more cost effective to own than to rent in many scenarios, and that paradigm is starting to level out. So we're seeing that historically, average mortgage payment as a percentage of household income is still extremely low. In fact, it's about a third less than the average over the past 30 years. And importantly, the consumer is still fairly healthy when it comes to credit score and their overall credit strength. This is important to see because as we move forward, what we don't want to see is the consumer taking a lot of debt, getting their credit score to now all of a sudden deteriorate, taking on a higher percentage of debt to income, and then we start to see some of the problems. So overall, I feel very positive about the housing market and what has to come there. This is a great stat to show as unemployment continues to hit lows. Here back in May, we hit 3.8%. If you look at that gray line, we really haven't seen these low levels since the 70s. And on top of that, we're actually seeing some wage growth and some overall inflation, which is important. If unemployment was going down and we weren't seeing wage growth, I would be concerned because that means people are essentially getting in this exact same jobs and they're not getting any raises, or in many cases, people might be having a job, but they're underemployed, meaning that they're working in a job that has a lower skill level than what maybe they're qualified for or should be in. So we're starting to see some wage growth. Obviously, that's really great to see. We'd love to see that creep up closer to 3 or 4%, but overall, it is very much trending in the right direction. So the big news right now, and I'm by no means want to get into politics. I know that we never have been at a bigger divide and a bigger difference of opinions. I have many of these conversations with you as clients, but we need to look at these things a little bit closer. And I need to provide some context because it does play into this, right? With media transmitting information at a never seen before pace, there's so much out there and we have to digest things so quickly and we're not always sure what to expect. So here we are in the midst of some threats over a potential trade war. Just this week, I know that it sounds like there's going to be some tariffs placed on some selected Chinese goods, and my guess is that the Chinese will do their best to retaliate. So what's really going on here? Well, number one is that if you look at the trade deals that the U.S. has created over the years, is that they're pretty favorable to the other countries. And this is not necessarily a Trump thing. This has been brought up in previous elections and administrations that the U.S. needs to negotiate better trade deals with some of these other countries, especially China. The problem with that is it's painful in the short term to go through this process. The market doesn't like uncertainty, especially when we see something as impactful as trade war. But nonetheless, we have to do this in some cases to try to gain leverage. And my assumption is, obviously can't put myself in President Trump's shoes, but that's my guess is what he's trying to do. I am by no means smart enough or a detailed enough microeconomist to really understand the intricate details of what this will do and how it impacts us as economy overall. But we need to remember that in the short term, this might create some volatility because it's uncertainty. So what's going to happen is in certain goods, in certain sectors, certain things, prices are going to go up in the short term. Doesn't mean that it'll stay that way longer term. So in some cases, this is an indirect tax. We're really seeing this a lot in the agriculture markets right now. They're being hit pretty hard because of the uncertainty. Obviously, we export a lot of agricultural related goods like beef, pork, corn, soybeans, the list goes on and on. So we need to see what happens. So overall, this is net negative to our economy in the short term, but certain industries like U.S. Steel manufacturers, companies that make things here specifically, it creates a competitive advantage for them because they don't have to deal with the tariffs that importing goods from China or other countries would have to incur. So overall, stay patient with it. My hunch is that when we look back our 3 to 6 months, this is likely a blip on the radar, and we've hopefully rectified the situation and we can move forward from there. So stay tuned. I really don't have a good solid insight for you there, but wanted to at least address that situation. So overall, the economy is very good. It's very strong. When you look at the numbers, I think we're all in fairly strong shape. What I wanted to do is just share a fun little fact for everybody. Since here this week, or last week I should say, we celebrated the 4th of July, or Independence Day. I came across a statistic, and it showed the average age of our founding fathers. Not the average, but just looking at them. And most of these gentlemen were very young guys. James Monroe, 18, Aaron Burr, 20, Alexander Hamilton, 21. And then we had John Adams, Paul Revere, and George Washington as, I guess, kind of the elderly veterans leading this whole process that we went through. So I thought that was pretty neat. I hadn't seen these ages or numbers really since I was back in my days in middle school and high school studying this stuff again. So overall, the economy is strong. It's good. Embrace that. Don't feel worried. Yes, at some point things will slow down and they'll change, but it really doesn't seem like that's going to be happening anytime in the very near future. Unemployment is low. The consumer is very healthy. And so those would then lead to people spending more money, creating a better economic impact, which then in turn are going to lead to better prices in the stock market. The political divide is at an all-time high. Don't let that cloud your investment opinions. They are separate things. Historically, political decisions have had very minimal impact on the stock market. Not always, but sometimes we can see that out there. So I just want you to be cautious of it and try to disconnect those two. So as always, I'm sure at some point we'll view all of this as a blip on the radar. But if you have questions, please reach out to anyone on the team. We're here to help. And please don't forget, excuse me, to enjoy the summer and have a great time with your friends and family. Thanks. Take care.